Okay, good morning and welcome to the Minervini Private Access Training Room. I'm Bob Weissman. If you can quickly raise your hand and let me know that you're hearing me loud and clear. Hope everybody enjoyed the weekend and yet another exciting football game with the Eagles winning in overtime, 10-1. Thank you. Let's also welcome Mark Ritchie into the room. Good morning, Mark.
Morning, Bob. Morning, Mark. Morning, everybody. Hope everybody had a nice holiday.
If you could just raise your hand, letting us know you're hearing Mark loud and clear. It looks good there. Yep. That looks good. So let's get started then with today's session with Mark Minervini. Good morning, Mark.
Hey, good morning, everyone. Hope everyone had a good weekend. Just real quick, note on the market here, of course, we've run right up the right side here very quickly, and you can see there's 4 or 5 unfilled gaps. So a pullback or some type of digestion would certainly be normal, but don't expect it absolutely for certain to happen. You may get pullbacks that might only be 1, 2, 3%, and we keep moving up in a V fashion, and the indexes end up in new high ground. So again, follow the stocks at this point. If the stocks are meeting the criteria, you can certainly be entertaining ideas now. And if you're getting traction, then you would ramp up the exposure. Let's see. List is not really that plentiful as far as buy ideas. So again, it is still selective and narrow, but we do have a lot of positions that are already open and on balance, a couple 9% dish profits, some fives, pretty decent action so far. So a good start of our first entry back into the market here from cash. Let's see what you guys are thinking and answer some of your questions.
All right. First question from Kelly, referencing at the gala event, the panel on the stage had an average loss of about 3%. He currently has an average loss of 5.5%, and he moves up his stop after the stock has a natural reaction. What are some things I could do to work towards a smaller stop loss without choking off the trades? It's
Yeah,
his question.
yeah, I know. I was impressed with that they all had a pretty tight stop. I think also Mark Ritchie has a pretty tight stop as well. Mark, you've probably been in the current environment. I would be willing to bet that your stop is probably been, or your average loss, I should say, is probably pretty tight, right?
Yeah, that's right. It's about this. What did you say, Brandon? Yeah, two and a quarter, just about two and a quarter. So, yep.
Wow, wow. Okay, so really, really tight. So again, and Mark, I'm gonna let you answer that because you're accomplishing even a tighter stop than what we were just referencing, 3%. And again, that's not every, I don't want to speak for you, but you're certainly not setting your stops at 2%. But that's where you're falling on an average. The thing I just want to point out is that remember the average is not exactly where you're setting your stop. And a lot of those sometimes, when you're real tight on the losses, you're selling stocks just below break even, maybe a stock that reversed on you. So again, it's a little misleading. But on the swing trades, historically, I would fall in the 3.5 to 4% to 5.5 to 6, depending on a good environment or a difficult environment. Mark, maybe you can talk a little bit about that very tight stop that you're averaging.
Yeah, you just have to be more incremental too, where like Mark was even saying, portions maybe, stock reverses and you take off a portion of the position and almost, as a general rule, tend to be incremental with almost all the selling, unless there's a sort of a major violation, and even if I'm going to sell, say, blow out of a whole position in one fell swoop, it's just because it didn't do what I expected, so maybe you just get out at a break even or a tiny loss, but then with the idea that I'll just jump right back in. So, and my win rate tends to be a little bit lower, meaning I'm doing a little bit more trading or sort of trading around the position and jockeying, to keep that small loss, if you will. But, I'm sort of paying for it in the win rate, where my historical win rate now is just a little below, it's about 39, a little below 40% versus say, 50-50, 2-1. But adjusted for, batting average, it comes out right around the same.
A couple of things I want to point out. First, incremental is definitely the key. Again, maybe you're selling some of your position as it moves back against you, and it's break even or it starts taking out, previous day's low, and then you sell a little bit more. Of course, as you trade larger, you almost forced to be incremental. But even if you take a look at something like the SPY models that I created, if you notice that I have them laddering, and what we found is that the incremental laddering works better than waiting for an absolute sell signal. And even when we ladder them up and down and don't have any absolute sell signals, just if you were to just follow them and just allocate, when they're 25%, go 25, when they're 50, go 50, you don't really lose a whole lot. You're in some instances you gain an edge, but the laddering works well by just bending with the market, even, and that's the S&P 500, which is like the most random. You would think that laddering and being a caboose with the S&P 500, you really would be behind the curve, but you're not. So with stocks, it really works. The other thing too is that when you're going to use those tighter stops and you want to average that tighter stop, well, now you've got to back into the tighter risk. So what you do is you do narrow the field, because that risk, that stop is actually a selection tool. When Mark's looking at a trade, he's thinking risk first, and he's backing into a pivot point or some type of, if he's trading near the danger point, it's all with that stop in mind. So what that does is that actually makes you more selective, which to me is a good thing. But some people, they're sitting there watching these stocks taking off, but forgetting the fact that there was a lot of risk there because there was a lot of volatility. So it's going to narrow down your your trading as far as making you more selective too.
All right.
I just wanted to add too, real quick, Mark, sorry, because part of the question was how do I get better at this without or get the smaller stop loss without choking the trade off? Well, that is kind of the risk. There are going to be times where you're going to wind up choking it off. You can't have it perfectly both ways, but that's where I said to have that plan to get back in. That's sort of the sacrifice. You're gonna sacrifice if choking off a few.
Yeah. But again, by backing into those tighter stops, and not, if you're in a volatile stock that's moving a lot, well, then you're going to choke it off, because the natural movement of that is more volatile. And that's, I think we're both saying basically the same thing.
Kelly also wanted to ask if you could review DFIN.
DFIN?
Yep.
Yep.
Buying that above Thursday's high he bought that on Friday when it cleared Thursday's high.
Yeah, I think it looks fine. It's a small base. I don't know much about this one, but I see it's coming out of a small base here. It looks like it's got some nice upside momentum here. So that looks pretty good.
Okay. Matt is asking if you guys can grade the quality of the current focus list.
I say it's okay. I mean, I would like, better right side development, but and I'd like to see a larger list, but that sometimes happens later, especially when you just run straight up the right side. And so that's what I pointed out in this weekend's weekend study session, is that if you take a look at the S&P 500, we haven't even broken out of that big base yet. So it's not like this is late. It's everybody gets worried that they're missing it. It's just beginning. Hopefully, it's just beginning. So the focus list, when you do get the market running up the right side, this is exactly what you'll get as a byproduct. And sometimes you have to wait for that focus list to develop and to expand and to proliferate. But it's I would say the grading of the focus list is going to be the STEM model. I mean, that's the grading. That's our grading. We are, the STEM model is a grading of the conditions based on our buys and our watch list. And so I'm grading it orange. I'm grading it neutral, where it's it's buyable. But I would still say we're not all clear, everything's working wonderful, but it's working pretty good. If you take a look, out of how many positions we have open, the grand majority of them are all up. No, we just haven't seen a lot of traction yet. Mark, have you raised exposure much from?
Yeah, a little bit. Yeah, I'm sitting around 2/3 invested, in the mid 60s.
Right. So he's pretty much in line, with the STEM model. Not that I could tell you right now, Mark's not waiting for the STEM model to turn. Mark is the STEM model. We are the STEM model. So it's a reflection more, but yeah, that's right in line.
Question being asked from John on the EME purchase, setting your stop at 207.60. He's trying to understand where you came up with that stop loss.
I just gave it some room to come below it all the way down to the 50-day. You know, with you see you have this angle warning here. See, the 50-day hasn't gotten a chance to turn around yet. And you got some pretty decent room here because if you take this breakout all the way down here is about 5%. I mean, you know, it go way down for 8%. It's down quite a bit. And I'm not going to give it that. I don't think we need to give it that much to show that it's not acting right. But could this pull back here and undercut this low and maybe come back down near the 50? Yes, it could, because again, I don't think it's going to, but it certainly could. I'd like to be able to go through that volatility. Now, again, that's the maximum stop loss. You have to realize that the stop losses that we put are maximum stop losses. That's the most risk that we want to give, or the most room we want to give the stock. So certainly, you know, we could be selling earlier or trimming if it's not acting right. I mean, if it moved up today and was, you know, came all the way up to the old highs and then reversed and came all the way to close at the low, I would probably, you know, reduce or tighten my stop. So it'll be dependent on, you know, the action here. But yeah, it's just down below the 50-day here. Just giving it a little room to undercut.
Okay. Bobby is asking on NVIDIA on the focus list this week. He's asking, is this not more of a megaphone forming starting from July 18th?
No, not at all. No, this is a nice large base, and you undercut the low right here. You got that undercut, and this is exactly what an undercut and a shakeout should look like. It should just come ripping away from it, just like it did. And now you're just building that handle here. And you know, I mean, the bottom line is NVIDIA. You know, this is, we want to talk about the top stocks in the world right now. You know, NVIDIA is definitely one of them. Whether it's going to continue, I don't know. I mean, the valuation of the PE has expanded. There's all kinds of arguments that this is late stage, certainly, but this is the hot hand. And so, you know, if this is going to set up, we're certainly going to at least point it out.
Okay. Matt was bought BLTE on Friday
Mm-hmm.
when it took out the November 20th high.
Yeah.
Sold half on the bad close Friday, holding the remainder with a stop at 35.90. Can you grade this setup?
Yeah, you know, I mean, this is really, you know, this is quite, as you can see, we've been looking at this before, and this was there was a question over here, if you remember. As a matter of fact, right here, I don't remember the conversation completely, but I know they either put it on focus or we bought it right here. I remember, and then it blasted off. Then back here, we got some questions about it over here, and I was waiting for it to tighten up. I said, you know, with this big base and this big decline, we definitely need to see a lot of tightening. It did over here. Right here is where I started watching it again. Right here, it got real tight, and this was really acting perfect here, especially for a big, giant, deep base like this. This is what you want to see, like all these iterations, and then really, really tighten. But it went the opposite direction. It never broke out, you know. And thankfully, because you know these sometimes they'll come out and then they fail and they suck you in. This just failed. Now you know it comes all the way back here. You know, 200 days just starting to turn up here. You know, not the highest quality setup as far as I'm concerned. So, but I see what you're doing here. I think right here, you know, was your first chance to buy it. I think we talked about this. We put it on focus list somewhere around here, around 1020. So this now pulls back here, and you know, very logical place to buy it, either on 1120 or where you bought it, turning up there. So that's fine. I mean, it's a fine plan. I think you're handling it great, you know, in a micro way. So just be incremental here. If it can, what I would do now is if it can hold here and then move up and take out this high that where you bought it, I'd probably just add it back right there. If you really want to be active, that's how. If you're really interested in being in the name, I'd add it back. If it could then just have that one quick pullback and then get back to the races here.
Question being asked about COCO.
Yeah, I know it broke out. This is one that actually Mark Ritchie put as a potential focus list. I'm the one who decided not to put it on here today. I don't believe he put it on. I did not put it on, and I don't think he did. There's just a lot of erraticness over here. It's big reversal here, buying right into that. It's definitely tight, So for a trade, I think it's okay. I like the way, it shot off the lows here. Once again, you see how we undercut right here. We just undercut those lows and create that shakeout, and then it comes ripping back. That's exactly how you want to see a stock shakeout. When it shakes out the low, but within, usually days, certainly within a week, you want to see it really start moving higher off of those lows, and rip up that right side and show that demand. Then we got the tightness here. The volume came way down, so that was really nice. I love the way the volume came down. Now it's coming back in. You're getting that 1-2 punch that I always talk about. So I mean, it's for a trade. It looks good, but it's running into that same area right here where it's consistently had trouble. Sold off here. You got this big reversal, broke out, then came back here. It just, to me, I don't want to go and play into this volatility zone. Again, in the market's, doing great. Everything's rip roaring. I might start stretching the rules, but I'm not at that point yet.
Lou is asking, how much do you take into account if the 50-day moving average is sloping up for breakout buys?
Oh no, that's fine. I'd like rather, we'd rather see it. Certainly the more momentum that you have to the upside, the better, as long as you're not extended or you're not, running up parabolically. If you're coming out of a base though, and you've got a lot of momentum and you've got more sharp angles on the moving averages, that's showing that you have more upside momentum. So that's definitely a plus, but it's not a requirement. So I'm not requiring a certain angle, even if it's flat or it's even moving down just a little bit, as we saw, today with EME. That's still a viable candidate.
Angelo is asking, what either do you need BHVN to do to set up to become viable, or at what price level is it viable?
Well, I mean, it's pretty much viable already. I mean, it's pretty tight here. It's just a matter of whether, I would take it or not. It's a bit volatile. Like this tightness right here is 8 or 9%. But this has obviously come up here and sort of wedged its way up and hasn't really built out a real, right side that has a whole lot of symmetry. But very strong, and coming off these lows, if you measure off the lows, you've got about about a 90% move. So this is really, it's just shy of a power play, type numbers. So that's how I would look at this, as a power play-esque. So, but it's pretty much ready. I mean, I would, prefer it. I love as tight price as you can get. I'd love for this to go inside here, even though 2 days, something like this with really low volume would definitely get me more interested. So, but it's certainly, technically it's set up already.
All right. Jerry is asking 2 questions in regards to your USIC short-term trading tactics. In your Q&A videos, there were many names. You either picked the low of the day before the breakout, the low of the day of the breakout, or a break-even stop. What is your rationale when choosing which technical stop you choose out of those 3?
Oh, you're saying on the stop losses.
Right.
Yeah, well, I mean, without seeing a trade, I can't really answer any specific, reasoning behind it, but it's always just based on risk and percentage and dollar amount and position sizing. So like if I have a giant position, those would be the ones that I would be low of the day, like really, really tight. I mean, there were times in the USIC where I was 4x leverage. I put the whole account. I remember one trade where I owned over $10 million, and I think the equity in the account was 2.6 or whatever it was. I can't remember, 3.6. It was a couple $1 million, a few $1 million, and I had a $10 million position. And I remember it didn't work out great. I think I got out of it at a loss, but I stayed real tight on it. So that would be the reasoning. It's always the same reason. I mean, Mark, you can answer this too. I mean, pretty much we kind of tether. In racing, there's this little mindset trick or this little like visualization that they teach you where your steering wheel is attached. There's a string from the steering wheel attached to your gas pedal. So then when you turn, if you turn left, the string pulls the gas pedal up. So as you're turning into turns, you come off the gas. As you straighten out, the slack comes back and you can go back on the gas. Though that's the same way I think of it with trading. Like, again, my position sizing, as my position size gets big and oversized, well, then, that string pulls on that stop and pulls it up because now, I'm at much bigger risk. So I'm cutting off that risk as quicker. I don't know, Mark, does that make sense?
Yeah, I mean, I'm not a race car driver, obviously, but the way I think about it too is the more confident I am in the timing, the bigger I can be. Or the better you get in terms of knowing, okay, if this stock is acting normal, it should go here. Well, I can take more size. Again, assuming, of course, that things are going well and that my timing of late is working, that I'm seeing the ball well.
Sure.
But yeah, absolutely right. And that's true regardless. You don't have to be 4x leverage to take that mentality, guys. That's one point I wanted to make. I've never traded, that large, but, large is relative to you. And the idea that the larger you are in any one position, the more you have to be cognizant of the risk. And I'm never going to take a very, very large position and then put a huge wide stop on it. That's not how it works.
Yeah, they're sort of tethered together, and that comes back to your risk of total equity. So that's really what should be guiding you is your risk of total equity. So your position sizing goes up, your stop has to get truncated to make up for that, to make sure that you keep that risk of total equity at a reasonable level. And you want to shoot for an optimal level. An optimal level is 1.5%. At the highest level, 2.5%. You don't want to be more than that. But you also don't want to be at 0.1% because then you're not having enough risk on to make any money on the account. So that's what really should guide you is the risk of total equity.
Quick follow-up question for your overweight positions. Actually, speaking of that, you mentioned that you frequently moved up your stop to break even as soon as you were at a profit. This resulted in you getting stopped out at break even 7 or 8 times out of 10 because of the tight risk management. What was the most percent you typically gave an initial stop before quickly moving your stops?
I don't know when did I. Is this something that I said at some point? You're saying like I said this. I don't know what you're talking about.
Well, I don't either remember you citing that statistic, but he's referencing in a Q&A video.
I don't always move my stop break even. If under what condition am I moving it? According to this conversation, what did I say that I'm moving stop to break even? Under what condition?
As soon as you were at a profit.
No, I've never said that.
You
So
mentioned you frequently moved your stop to break even as soon as you were at a profit.
no, I don't think I ever said that either. So if you can find where I said that, point it out. I mean, yes, at times. I mean, maybe you're referring to that year, and when I was trading the larger size and I was keeping things really tight. I mean, there are times where in certain conditions I will do that. Yes. I mean, I might have said that in the certain, but overall, generally speaking, that's not the rule. That's not the default rule of thumb. But again, it's not a horrible rule. I mean, if you want to be really tight and you get profitable, you will be choking off a lot of trades though. You definitely will be choking off a lot of trades, and you're going to have to do more trading and be in and out a lot more. So there's a price. Look, there's always a price. If you want to give the stock more room, okay, you won't get stopped out as much. But now if you run into a string of losses, you're going to take a bigger loss. Your risk of ruin goes up. If you want to, cut it off and be really, really tight, yes, you're going to keep your losses very small, and you'll be able to now have more trades go bad and not have as much of a loss. But now you're going to get knocked out of a lot of trades, and you're going to get knocked out of trades only to watch them move higher, and your batting average is going to come down. So, you got to find that it's sort of finding a mix between what's comfortable and works for you and your strategy, and also what the market at the particular time, the environment is allowing for. The theme of the market and the volatility in the market. And I just try. What I try to do is I think I look at it the opposite. Most traders are trying to get away with as much volatility as they can. I'm trying to see how much, and this goes back to Renee Hirsch's uh, uh, question or comment that I loved at the gala event this year was, well, how could I trade the smallest? That's what I'm always trying to think. How can I get away with being as tight as I can? How can I get away with a break even stop right away? Can I pull this off and not, ruin the trade? So I'm always thinking that way on how to improve the worst case scenario. And it's a good way to think as a starting point, but doesn't mean it's a general rule of thumb.
Jerry just said he's following up. He said for overweight positions, he frequently moved to break even. Okay.
Yes. Now for overweight, that's a different story. For an overweight, then I'm not going to let the stock sink its teeth into me, especially once it gets profitable. As a matter of fact, if it gets profitable and I get a decent gain, I'm usually taking some off, and I'm financing, the position, and that's one of the reasons I go overweight a lot of the times is not because I'm trying to build a big giant position that I'm going to hold for days or weeks or months. It's because the stock is set up really well, and it looks like a breakout is imminent. And as it starts moving, and it's confirming, I'm trying to get a profit as quickly as possible. The largest profit I can with the smallest amount of move. So even if the stock goes up, where you would normally, let's say 8%, you need to sell off half of your position to finance your 8% stop. Well, if you have a double position, well, now it only has to go up 4%. It goes up 4%, you can sell half, and you've essentially accomplished the same thing. So it's usually I'm trading larger to leverage that, to leverage that in a way where it pays for risk. Even short-term trading, like I'll sometimes short-term trade and grab a few small profits. And I'm not looking at that as really a profit center. I'm looking at that as gathering some profits to be able to now use to be more aggressive and to take a bigger chance somewhere else, but with profits. So always thinking in those terms.
Speaking of the USIC, the latest results for October are now out, and we still
Okay.
have Deepak in second place with a 241% return. So phenomenal job.
Oh, fantastic.
And Renee is still right around second or third with 89%, but she just updated me in real time here at almost near the end of November. She's actually at 136% year to date.
Oh wow! So Renee's hitting the afterburners here. So, but Renee, if the results are out, Bob, she can't be in second or third. She can only be in one or the other.
Well, actually,
Which one is it?
so her results are not actually on the page, but she told me where she's at, and I can see where people's reported numbers are at. So
I got you. All right.
they're down to the decimals, so it's very close.
And I think for those of you who came to the gala, and if you met, especially if you took any time to speak with Deepak or Renee and Roy and some of the people, Anish, that were on the panel, I think you will find that not only are they extremely fine human beings and just great, wonderful people, like everybody there was just so many great people. Larry Height, by the way, I just want to say for those of you that came, Larry Height came up to me and said, this is the best time I ever had in my life, and never in my life have I seen an amount of people in mass that were so hopeful and happy and on the same page and had a common goal. And he just was blown away with the quality of the people. And I told him that before he got there. I said, you're going to really meet some wonderful people, and you're going to feel really good about doing this. So he did. But if you talk to Deepak, if you talk to Renee, you'll see that these are very, very calculated, calm, meticulously calculated people that are doing this in a very unemotional way, and really, really, like I said, very meticulous and very calculated. And I don't wonder once I spoke with them, I'm not surprised at all of their performance, because that performance is going to be a reflection of your personality and how you're approaching this with mentally. So I'm very impressed with all of those people.
And I should also mention though, Govern, who is in first place, Deepak's at 241, Govern's at 571, way out in front. He is a private access member as well.
Oh, I didn't
And
know that.
and he is he actually sent me an email where he specifically says all the credit goes to Mark Minervini as he follows all of your teachings religiously. So
So he's up over 500%.
571
Oh,
versus
wow,
Deepak's 241.
that's amazing. And I'm just going to say right now, all the credit does not go to me because there's lots of people out there well, there's thousands and thousands and thousands of people. There's millions of people around the world that have studied my work, and thousands that have been coached by me, and they're not winning the U.S. Investing Championship. So certainly, great job. We're definitely going to have to speak with him.
Yeah, and obviously I know a lot of people at the gala event came out very motivated, very pumped up, and certainly talked about joining this year's event coming up, of course, starting on January 1st. And that's, great if you are. And it really, I think from Renee's standpoint, she shared with me how much it really allowed her to really focus and really, really hone in her skills and not sort of take it lightly. And it really helped the mental acuity as far as staying sharp all year,
So
particularly.
again, next year gala event, we're going to be doing another gala event. It's actually going to be, I'm going to give a little hint here. It's going to be 2 days. Okay. Day two is going to be something really, really fun and awesome. I'm not going to announce it until January. But the gala event is going to be in January. We're actually pushing it just outside the end of the year. It's going to be January 18th and the 19th. I'm pretty sure that those dates are in stone at this point, so I can say them. January 18th and 19th of 2025. We were going to have it in November, but we're going to push it. We're going to have the Master Trader Program, looks like November, and then just another month and a half, 2 months later, the gala will be pushed into 2025. So the 24 gala will actually be in 2025, right in the beginning, and then you'll be. I'll tell you why in January, but I assure you it's going to be tremendous fun and it's really, really special.
Yeah, a lot of details to be shared with you, and
Yep.
this year's event really allowed us to, I think, see how to even make this a more exciting, more involved event. So we are already deep into the planning stages here for the next one.
Yep.
Let me just get a lot of comments here now about people looking to join and participate in the contest. Renee said she'll be competing again for next year as well.
Yeah, you guys should really do that. I mean, you should get in and then come and put your results and get in there. It's gonna help you. It's gonna help you be more engaged. And it's a great thing. Competition's great. Competition creates creates champions. That's why I compete in everything I do. Race cars, shooting, all the things I always compete. It brings the best out of you. And that's something that you guys should really get involved with and just have some fun with it.
Jeff is asking, when you say you sell at a multiple of your risk, and let's say you have an 8% stop on the trade, but your average loss is only 5%, are you looking to sell at 10%, 2 times your average loss, or would you need to wait for 2 times that particular stock trade's loss?
Yeah, I'm not really thinking of it that way. I mean, we certainly, and Mark, I'll let you answer this. Also, we're not thinking of it as, oh, it goes up X amount, we're selling it because we risked X amount. But certainly, you've got to have the context that if you're averaging, your losses are averaging, 5-6%, or you risked 8% on it. Well, you're not going to be a profitable trader if you're on average, habitually taking 4% profits. So that sort of has to be in the back of your mind, but it doesn't mean that the stock's not acting right. Or if you're trying to build up some cushion and, you don't trade some smaller profits, but there's got to be a reasoning behind it. In your plan, there's a plan there and why you're doing that. But again, with swing trading, you really should be, if conditions are right, if your average gain is, 4%, well, then you've got another problem, or the market's bad. So now again, you've got a way to compare and contrast, right? If you're looking at all these stocks, they're breaking out and they're taking off, and you see, you know, all these breakouts are up 10, 15, 20%, and you're averaging 4%, well, then you're selling too soon. You know, and this is where the post analysis comes in. I mean, Mark, I can go in a lot of directions with this. This is opening up sort of, you know, multiple doors. But what's your feeling on that?
Well, yeah, in general, I would say, look, I always like to have my average loss and gain in my head, of course. But you know, I think he used the example if you took, say, a little bit of a wider stop. Well, and the current this BHVN, you know, is a good example of one you just measured 8 or 9%. Well, yeah, most likely in a name, if it's a little more volatile right side, and I'm still going to get on board, I'm going to have that in my head as well, though. But also these stocks, you know, you sort of, I feel like in the same way you get the look, you know, before the setup, you sort of get the look after the setup, you know, to say, you know, is this acting well? Is this doing anything wrong? Is this extended? You know, a stock like this is not going to be extended up 10% because, you know, the pivot is 8 to 9% wide. So I'm always kind of thinking more in that 2 to 3 to 1, you know, versus, you know, well, what was my actual trade stop versus my average, you know, because that average, again, it's an average. It's going to come out. It's going to be somewhat of a moving target. But you do enough trades, you're going to know based on, you know, your tactics where you're at. I don't know if that makes sense, but that's how I think about it.
And I think the comment is thinking of it in reverse. And a lot of people they think of it this way, and they start looking at where they should be taking the profits based on the loss, which is completely backwards because the profits are the area that you don't control. And that's the area you have to try to optimize through probabilities. So I think of it just the opposite. Where should I cut my loss relative to where I'm taking my profits? On the profit side, you want to try to make the profits as big as possible. That's the goal, to optimize that and get as much juice out of the lemon. Now, if you're a very short-term trader, that number is going to be much smaller than if you're a swing trader or a longer-term investor. So that's the number that's key, is where your gains are. And I'm been working really hard on my new book, which I'm trying to finish up as quickly as possible. I'm working to finish up as quickly as I can. And I was just writing about this and calling it the pace car. You know, that's the analogy that I've been using, where that pace car is in front of you, and you're driving and there's a car in front of you, and you have to keep a certain distance for safety. You know, if you're riding the bumper of somebody in front of you, they tap the brakes, you run into them, right? So you keep a certain distance. Now, the faster you go, the more distance you're going to have to put. So that the speed of that car in front of you determines the distance that you stay away from it. So that's how I look at trading, is the average gain is my pace car, the average profit. And then now when I'm above that average gain, here's what I'm mindful of. I'm mindful of the fact that I'm now, if I sell above the average gain, what did I do? I improved my average gain. And that's the goal. The goal is to make that average gain as big as possible. So by keeping track of that and say my average gain is 8%, and now I've got a 13% profit. Well, that really argues to protect that average gain, at least with part of that position, because I've now accomplished my goal, and I've gotten above my average gain. I'm improving my average gain, and that's moving the ball in the right direction. So I'm mindful of that. Doesn't mean I'm necessarily going to sell it, right? Because I'm still going to watch the stock, and I'm still going to base it on how the stock's acting. If it's acting great, then I go for a bigger gain. But again, trading is about marrying the risk reward relationship, the math and the management of that in with the trading and the technicals, and making a decision whether, how you should be applying that. That's why it's an art. It's an art, and it really is. And the really cool thing is that the human brain is the most amazing. If you ever have a chance, you should check out Dr. Joe Dispenza, because I'm not sure I've ever heard anybody talk about the brain as well and as informed and as clear as Dr. Joe Dispenza. I love Dr. Joe. He's awesome. And as a matter of fact, he just had a seminar in Orlando, and I wanted to go, and I couldn't go because I had other commitments. I was really upset that I didn't get a chance to make it. But we have the capacity to compare. It's this amazing supercomputer that there's no computer can come close. We can take 1,000 bits of information and compare it to 1,000 bits of information and weigh them relative to each other, and with all kinds of scenarios, thinking forward and looking backwards, and do all that in a nanosecond. And that's why the art is so awesome to bring into trading, and that's why it's virtually impossible to, at this point at least, where we are with computers, to duplicate that. Now, artificial intelligence, we're using the best artificial intelligence that you can find right now. It's costing me a lot of money for what I'm doing with artificial intelligence right now. We're using the absolute best. And as unbelievable as it is, and everybody thinks, they're all worried that it's going to take over human beings, what I'm finding out, what I'm learning is that it is really amazing as a tool. It really is amazing. But I'm also learning that compared to the human brain, it's ridiculous. It's not. It's an embryo. It's not even an infant. It's like it's 100 billion miles from the human brain, and we've got nothing to worry about for a long, 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 long time.
All right. Question: if an outside day makes the success of a breakout less probable, example being BBIO today.
If an outside day, no, I wouldn't say that's, you could really read into that. You got to be careful about reading into just one day's action that's on low volume and isn't, much in price action. Um, no, it can actually be just the opposite. I mean, as it comes off and undercuts low, has a good close, that's what I love to see. We love to see those undercuts, good closes. Maybe you go inside for a day and then come out, but it has to be put into perspective. And so now, if this is an outside day and you're closing on the low, and it's on big volume and there's a wide range, yes, that would definitely lower the chances that it's breaking out, certainly today. So it has to be put into perspective. You can't just say one day, or again, just like Monolith, it's a tool, and you've got to look at these readings in context. Context is really, really important. But this is starting to shape up here. I mean, this is building out this right side. I'm watching this real closely here, and I would love to see just, go inside here, a day or two, one day outside, next day starts coming out here, and I'll probably buy some here. This is, setting up fairly decent. It gives the 50-day a chance to start flattening out and hopefully turning up here. So that's that development that we want to see.
Dom is asking the question to Mark Ritchie. When you are invested, are you typically evenly invested across the board, or do you discern aces and kings with more size?
Meaning, do you go bigger, say, in the better hands, if you're using the poker analogy? Is that well, ideally, sure. Of course. And right now, I've sort of taken a little bit of a shotgun approach, and this is where sort of incrementally stepping up size. But yeah, we start to see the more ideas and potentially even tighter, then I'll look to even get more concentrated. And then part of that is liquidity is the other thing as well. Of course, you might have aces, but if you don't have the liquidity, then you can't put on as big a size.
Yeah, so I just made a note while he was, just before he was talking about how to answer that, and and of course, in perfect form, Mark answered exactly literally the exact words that I was going to say. So it's same exact answer. And that's what you're going to see. That's one of the things here where, when I see, guys like Mark and Brandon and all the people that I've trained and people in the U.S. Investing Championship, of course, now this gentleman who's up 571%, that's really encouraging. And I see the duplication of the process and the thinking, that's that's the main reason why we do this, is because we know that we can transfer it, and it's teachable, and there is a structure to it. So, but there's a lot of art, and you have to interpret. But look, you can teach somebody. You go to art school and you learn how to paint, right? You go and then you got all this creativity, and you have these artists that are doing all these different paintings, but there are fundamentals. There are fundamentals to learning on how to how to paint and with art. So again, same exact answer.
Ben is looking at Eli Lilly over the last 1, 2, and 5 years. It has run up a lot. If Lilly
Yep.
sets up a buy point here, would this breakout be more of a trade since it looks to be very late stage?
It's definitely late stage. There's no doubt. I mean, I've been looking at Lilly since way back here. There was a bunch of times, I tried to get on board this and it really never really set up a big base. So I agree with you. It also is the best in class. So Lilly is definitely the best in class. I think it's later stage, and I would look at it as more tradable, as well. Yep.
All right. Carolina, can you please help me understand? Okay, so the stage 2 warning on Monalert, we did actually post a note last week, Carolina.
That's just telling you that one of the, I think we're using 7. We're not using the 150 over the 200 on our stage 2 warning, but it's telling you that there's a violation in there, at least one violation that the criteria is not being met. So then it's not in confirmed stage 2, because confirmed stage 2 is you have to have all the criteria. What we're doing now is we're going to make it where you can actually see when it does that. And I'm not sure how the programmer is going to do it, whether it's going to be hovering over it, pull down menu. You'll see the criteria and which criteria it meets and it doesn't meet. It'll be like a checklist. So then that's going to happen fairly soon, probably within the next week or so. We should have that.
Yeah, and with that NVO stock, which is what she's citing, which did have a 2-for-1 stock split, some of our charts do not update those stock splits.
Yeah,
So we are
it's
working on that
unfortunate.
too.
Yeah.
But the data provider, it's a little convoluted. No need to explain the details, but we are aware of it, and it is something we're working to achieve that.
NVO looks good though. I mean, it came out of this space. It's choppy. It's an ADR, right? Yeah, and so it's a bit choppy, but it looks pretty good. We've had that in previous weeks, of course, on Pilot.
Yeah.
On a focus.
Hassam is asking if is PRO a valid pullback buy today?
Hold on, let me just move something here. PRO Pro.
Right.
Haven't heard that name in a while. So I just looked. That is on my watch list. Matter of fact, looking at it now, it looks like it needs to be brought up probably to focus at this point. So we do have it on the watch list. So is the question of valid pullback buy today?
Yep.
Well, yeah, I mean it did pull back. You got 1, 2, 3 lower lows, and then it turns up from there. The right side looks like it's a little short. And so when I have that, where maybe I just have a few days, around that third lower low, fourth lower low, that's where I'm looking for that support and looking for that potential pullback buy, similar to right here, 1, 2, 3 lower lows, and then boom, right? You get the support here. So I would be looking for the support here, but sometimes you may get an outside day or get a fourth lower low, pull back a little bit more, or maybe another day comes in here. So I try to give it that room where, I mean, there's 2 ways you can play this. You can play it. The answer is yes. Today was a valid pullback buy. So let's just say you went in. Well, one way you can play it, look, if it goes outside, takes out the low, you're out, right? Another way is, maybe you give it, you stick with it, even though it reversed here. And now, to use this low this is where it's real tight, right? This is where, you're buying it here. This low is 2%. Again, so tight that very likely without it just taking off here that you'll stop it. So I'll sometimes allow that to take out that low and maybe come down to the 20-day or so, use a percentage stop. Maybe I give it 4 or 5%. Or another way is I want to give it more room, so I'll cut it back a bit. Like here, it's not working. End of the day, it doesn't close well. Cut it in half, but give that other half a little bit more room now. So now I let it come down a bit. Maybe it can stabilize over the next day or so, and I get another pullback buy, and then I add back. Those are the sort of the different ways I would look at that. But it's shaping up here. It's definitely shaping up. And I'm going to add this to the focus list for sure.
Okay. Fred bought MDB on November 20th.
Yep.
Was it too little of a pivot?
On November 20th, which will be right here, of course. I mean, for me, it's a little bit. This is another one that was on watch list. And you see, you had the little minor angle warning. It was just, well, actually there it was just starting to flatten out. So you really didn't have it there. So it just started to turn up. But you can see it's a little early as far as the trend. It ran up the right side and wedged up a bit. So you didn't have a whole lot of right side. But the whole market did that. So yeah, I think it is. And this is why this made my watch list, but it didn't make my focus list. So again, if you really know a lot about the company, there's something really great going on and you want to own it, well then, I would use this pivot, but not something that I'm going to stretch to own.
All right. Just a quick announcement as far as none of our holdings have any earnings scheduled for this week, but we do still have some, and always be mindful of earnings. Next week, I think we have a handful of our names. So retail in particular is usually delayed. So I believe our retailers all are next week. Michael is asking, or he noticed differences in the charts. Okay. Let me just read this. I'll come back to it in a minute. Toby's asking, I'm interested in buying NU because of the strong fundamentals. Do you think it's an
NU.
acceptable buy above $8.30?
I don't like it. I mean, look at this big gap here. So this is definitely, the megaphone action. What's that?
That's
Yeah.
on earnings, yeah.
Yeah, where you're tightening up here, right? And you break out here first on 11:03, I'm sorry. And then you tighten up nice here, right on top of there. You come out again on a little gap there, but then you get popped here. Is this on earnings right here?
Yeah.
Yeah, so now you get popped on earnings, and now see you're getting the volatility's, widening. And that's not exactly what I want to see. So this sometimes you play this on a reset, where you set a new pivot, but going right into that gap here, I would not play it here. And then when we look at the fact that it's an $8 stock, then I really want to shy away from volatility. So it's already a lower quality name being trading at such a low price that I discount it right then and there. But now it's not acting right. Now a low price name that's not acting right. There's better places to to focus on, I think.
I think maybe adding differential disclosure, if the earnings are so good, why is it coming off of the new highs? As a general rule, when you see those big earnings prints, you want to see the stock acting the other way and then look for some type of a reset on the right side, not coming back into supply.
Yeah. Now I want to see the smoke clear. Now that it didn't act good in the earnings, I want to see the smoke clear and maybe, and see it really give me a reset here. But a reset right into the gap like this doesn't have the look for me. And as an $8 stock, I think isn't this a steel stock? I think this is a steel stock.
Online
Oh,
banking.
banking. Yeah, that's right. Online. But yeah, and a bank stock again, I treat that sort of like the cyclicals. So not making my cut for sure.
All right. The question Michael is referring to was he has his charting with his charting software adjusted for dividend adjusted charts, is what he's saying. And he notices a difference between some of the charts that, for example, SPOK, if you pull that up, he's showing a difference in pricing of the two.
I don't know. I mean, usually the charts will adjust.
Yeah, that's what my experience always is as well, Mark.
For dividends.
He's asking, should he turn off dividend adjustment feature on his charting?
I don't know what charting you're using and how it's affecting the chart, so I can't answer without knowing that. I'm not going to give you advice blindly, So I don't know. But the chart should adjust for dividends. So I'm not sure what charting you're using.
Yeah, maybe Michael, you can send in an example and that information. Roberto is asking, I read that you guys look at hundreds of charts every day. As a newbie, should I be doing the same in order to train my eyes, but not sure how that complements the focus list? I mean, if I could just find good setups besides focus list and not get overwhelmed.
It probably won't complement the focus list too much. If you're applying this in the way we're applying it, you're going to come up with a lot of the same names. And of course, we're cutting out that work for you. But and then we're going to be giving you the screens very soon. Within a matter of weeks, we're going to start having screens available for you where you can just look at the names right there, right on the charting on the left side. But we don't always look at hundreds of names, you know, so it's you know, once we do this weekend screening, you know, that doesn't update dramatically. You're not going to see a big difference, but I do screening every day. I am looking, and there's different screens, but I'm mainly running, you know, the RS screens and running the IPO screens and running the same screens over and over. And then depending on the market conditions, I might run some utility screens. You know, in a bear market, I'm running RS line screens. I'm looking for RS lines that are moving up, new highs, close to new highs, stocks that are holding up the best against the market. So, you know, if you get a little correction, maybe, you know, you get a correction that's 6 or 8 weeks, you know, you look at stock, you look at 8-week, you know, relative strength performance, you'll find the stocks that held the best during that period. Those are what I call utilitarian or utility screens. But yeah, I mean, do you need to look at hundreds a day? No. I mean, you can. I think Renee said she's almost exclusively trading off the focus list, and she's trading options. So I found that really surprising and interesting and impressive.
Michael's asking if JBL is too short of a base to add to your watch list.
JBL, we've been watching this for a while now. It's not necessarily too short, but the thing that I'm always careful of is the shortness in perspective. If you see, it had this quick run up here, this big move, and hold on, I'm getting locked up again. Yeah, just updated the software too. So you get this run up here, and I don't know how much did this run up. Yeah, this stock ran up about 34%. This is about the kind of the minimum level for a climax type run. But these extended moves where you run up and you're running up at a certain angle, if you will, and then you accelerate. And this didn't accelerate dramatically, but it did accelerate. And then you get the small base off the acceleration. I have found that there's a lower success rate in those, and I'm usually careful with those, or I just trade them. This is more of a trading type situation. So small base after an accelerated move, I discount. You know, and that would be my you know, my words of warning on this. But and if I'm gonna trade it, it's got to be really perfect, and it's got to be tight, because now if it's more of a trading situation and it's a higher failure rate, I've got to make up for that in risk. So now I want it to be really tight. I want to have the stop probably tighter than normal, or backing into a very, very tight pivot point, because now I'm going to probably just trade it, and the failure rate being higher, you know, I've got to account for that.
Manon is saying it looks like Amazon is setting up, already broke out of the pivot now, and we had just put it on focus list. But what is it about the setup that keeps you away from buying it?
It's not the greatest setup, first of all. I mean, it's, you know, and again, this is going to be, I mean, you maybe get some leverage on the market, but this is the market. You know, these stocks are the market. So, you know, I mean, you might as well just buy FNGS, you know, MAGS, you can buy MAGS, FNGS. You know, these are, you know, FANG and indexes. I mean, you're going to get those, you know, the Magnificent Seven, if you will, because that's what you're basically buying, except you're taking that one single stock risk. So you get a little bit of diversification here with the you know, the power behind that group. It's just more of a market stock, you know, and I think the market looks like it could pull back here. So it's not a perfect setup, but you know, you do have to, like I said, Nvidia, these stocks, what they're setting up here, I mean, you got to put them on, you got to entertain them. This is, you know, certainly, you know, your core positions if you were to be wanting to have market exposure. But I'm not chasing this up here.
All right. Would ARCB be an example of too time compressed?
Let's see. Oh, I'm sorry. ARCB. Yeah. I mean, not really. If you look at this and you go in my book or the Master Trader Program workshop and you look at some of the examples of the time compression on the right side, this would be a poster child. So I would definitely not buy this running up this quickly like this. And if I were going to trade it from a very tight pivot as it was moving up, that's the only way I would ever trade something like this. I would be trading it. If it runs up more from here, I'd certainly sell right into it because now it's just getting hyper extended up that right side. The only difference would be if this was a double and we're looking at a power play.
Question.
I do have to wrap it up though soon, so we got maybe 1 or 2 more questions.
Okay, thanks, Mark. Toby's just asking, what do you think about waiting the first 3 minutes of the trading day? I found that there often are a lot of fake breakouts at that time.
Yeah, I don't see a lot, I mean, are there some? Yeah, and if something breaks out right exactly on the open, I usually do take a little pause. So I think that's fine, but that just hasn't been a problem for me. I haven't noticed that to be some problem that's sucking me in and causing these big problems with my trading by, trading on the open. So taking, a couple minutes or so, and I know, David Ryan used to say he gives the first 15 minutes or 30 minutes. He sort of, sits back and doesn't trade. I think to have a hard number like that, I'm not going to do that. I mean, if there's a stock that looks fantastic and it's breaking out of a base at 1039, 939, I'm most likely going to just buy it. I'm not going to worry that it's only 9 minutes into the trading day. But right on the open, yeah, I mean, especially if it's low volume, stock breaks out on 100 shares, 5 seconds after the open, I'm not going to just jump in there.
During Michael's weekend scans, he's noticed most stocks meeting the trend template are already extended. Do you make the same observation? Should this have any influence on our trading decisions going forward?
Absolutely. That's exactly what we're seeing. We're seeing that a lot of stocks have run up with the market up that right side, and the stocks that are in uptrends now are not buyable. A lot of them are not buyable. So that's what, you have to wait. Look, you can have a company that's fundamentally sound, but it's not price ready. You can have a stock in an uptrend that is very strong and it's in a strong uptrend, but it's not price ready. Price ready is from a VCP, and the reasons behind that, most of you know why we're trading from the VCPs. We're looking for that supply to stop coming to market so we can time those purchases, get at a profit as soon as possible, look align ourselves with the line of least resistance, so we can buy when the supply stop coming to market and that uptrend that's so strong can resume itself, and that buying can really have an effect on a stock that now doesn't have much supply. So that's price ready. So that's where you have to wait for the stage 2 trend, or being in an uptrend, is a qualifier. So trend template, you're looking for those stocks. You see there's 500 stocks in uptrends. Okay, that's great, but they might have a lot of stocks extended, and that's telling you that the market might be ahead of itself, or certainly, your universe. And that's all that really matters, is your universe. The indexes are extended. That's not going to make me not trade stocks. If there's stocks setting up in bases, I'm going to trade even in an extended overbought market. But conversely, if the market might be doing terrible and I've got a bunch of stocks setting up, I'm still going to go with stocks.
All right, Mark, if that's the case, let's wrap it up there. I know we didn't get to all the questions, guys, as usual, but save any questions that we did not get to for the next time.
Yep.
And I believe we'll have Mark Ritchie and Brandon on Thursday as well as an opportunity to ask questions, but stay tuned to the live stream for real-time alerts throughout the remainder of this week, and we will have the replay of this posted here momentarily. And with that said, thank you, Mark and Mark, for your time.
Okay, I think it was a great session. There was a lot of good questions, and I think we got some good answers there. So talk to you guys soon. Monitor the platform.
All right, take care, guys.
Bye-bye.